Now, before we get into segment 2, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So we always like to kick off looking at the aggregate, the average of gasoline, jet fuel, distillate, and residual to look at, where are we progressing overall. So here you had that big spike from the colonial. You had those 2 big weeks that got us to that 2019 average, and now we had that that normalization getting us to this flatlining. And again, we're going to sit at a fairly fixed rate at this point, given some of the push and pull back and forth on that implied demand side. But here, when we look at, the typical 17, 18, and 2019, you can see that normally this is when we kick it off. So it depends on when it starts. So if you remember 2019, Memorial Day was a little bit earlier. I think it was earlier by about 4 days. So that was where things started a little bit, had that nice little spike a bit sooner, and that started to drift higher much quicker. And here it typically takes till about, let's say, the end of June before we get to that 16,000 barrels a day of demand. So right now the current is 14.68 versus the 15.42 that we saw the previous week. Again, that's that impact from colonial. And then that's bringing us to that 4-week rolling average of about 14.788. So we're starting to see, again, that average is pulling up, but this is where we're seeing some of this friction back and forth, because distillate's going to have a nice jump. Jet fuel is going to have a bit of a drop. And then that gasoline is that swing component, because at this point, the gas buddy data, the Descartes data is showing us that things have gotten better. But based on the way the calculation works, there should have been a much bigger drop in the EIA calc, which just means that there's going to be one more week of catch up in terms of that progress from the, essentially the blenders to the racks, to the truck, to the end, the actual pump. And that's going to be that delta as to how quickly does that come back. We will see it normalize around 8.99 million, not saying that it won't, but seasonally it's supposed to, and it's actually below where it should be just based on this point in time. But we're going to have one more of that kind of noisy number before we start to get into a more gradual increase along those seasonal levels. So then when we shift to distillate, so distillate had a big build of 3.7 million. That brings us, we're still below the 5-year average by 11.4, but the biggest draws remain in pad 1. So pad 1 still has that draw of 11.8, and pad 3 is still sitting on a fairly large number of 5.9 million above the 5-year average. As we were saying last week, we actually had a fairly big move in imports, and that actually showed up where here we had an increase of 267,000 barrels a day into pad 1, which takes us essentially 388,000 above the 5-year average. That will start to abate, but we've actually had, so as we said last week, a lot of product was coming from the Middle East and Asia, and was initially flagging the Europe. And because Europe has seen some steady builds, we've actually seen some diversions, and those diversions have come, or I should say they've diverted into the U.S., while we have another an ultra-low sulfur diesel behind it. And then we've actually had some jet fuel that's going to be imported, and some has moved into Morocco, some have peeled off into Africa, just because Europe is, they bought a lot. There was a lot of in the R, but now they're seeing some better markets because Europe has softened a bit. And that's going to continue to play out, which is why we'll also continue to see these builds in the U.S., even though diesel's going to remain very strong, just given the shortfalls in the supply chain. So here you can see the rate of change was pretty drastic and well above the normal 20-year kind of build line. This is just going to be noisy, but we're at that pivot point where we're going to continue to see steady builds. I don't think they'll be at this rate just because jet fuel is going to remain recovered. So you'll still continue to see those builds, just because you need to, depending on how you're making gasoline. When you make diesel, you inherently make gasoline. So it's going to be a matter of how do you kind of manage some of that. And when you look at the ultra low sulfur diesel, it's still 9.3 million below the 5-year average. So there's still spare capacity in these tanks So you can make, especially if you run a heavier blend of oil, you can then make a fairly balanced suite of products between that middle distillate, light distillate, aromatic side. So that's why we think those imports are going to increase, especially because they're fairly open to bringing them in from West Africa, which is that nice kind of Goldilocks crude of that medium sweet. Now the PADD 3 can handle heavy sour. It can pretty much handle anything, but it's just going to try to take advantage of what are some of the differentials in the market. So here's where, when we look at distillate in general, you can see it fell along those seasonal lines. We expect to see a bit of a bounce up. It's not going to be at the same level. It'll still fall within that average. We still think it'll kind of maintain above that 5-year average. As things remain strong on the trucking side, rail side. So it won't go to a new high, but again, kind of stay elevated within that upper range. And this is what we're seeing, where we're seeing some of that flatlining following the holiday. This will start to accelerate again. The one to watch will be load availability, which has come down a bit. That will start to pick back up. The biggest issue overall is going to be rates, because rates continue to drift higher. We're going to cover it in a second, but FedEx has increased their surcharges again on top of what they've already increased. So we're continuing to see these diesel surcharges getting levered into pricing, because really fuel is a pass-through, and they have to find new ways to pass through this steady increase of diesel prices. Now, we think diesel prices kind of flatline here. They'll still trend up a bit, but not at the same level. But again, they're still going to remain elevated, still going to be an impact to inflation as we get drivers from food and other that continue to be the problem, with gasoline seeing another slight trend higher. And that was, I think, something that we had been talking about, where even as Colonial normalized, those prices were going to stay sticky, because they typically see an increase going into summer driving. Instead, that just happened a little bit earlier, and now it'll just remain in place. And that's when we shift into rail traffic. So again, the versus 2020 is going to be tough. But when you look at that year to date and you look at the general trend, grains, forest products are going to remain elevated. And because there's still this difference between PADD 3, PADD 1 movements, we're going to continue to see petroleum and petroleum products remain elevated, especially as we see more activity happening in the Bakken. Given DAPL has now officially been kicked into 2022, you're going to see a bit more activity. That's going to increase the movements. And then intermodal is going to continue to be a huge driver, because we still have these massive shortfalls on the inventory side. We talk about it really the last 2 weeks in the Econ show on how steep these inventory shortfalls are. And while trucking is a great stopgap, you're only getting one cargo at a time, where if you look at rail cars, you're getting 100. Now, not that a company owns all 100, but you can have multiple deliveries of cars versus just that one truck, which is just gonna have to increase to try to backfill this massive shortfall. So again, rail is going to remain elevated as the levels continue to hit the coast. And this is, year over year is ugly. We know it's going to stay ugly. We're focusing more on week on week. And we continue to see this week on week remain very elevated. We're not seeing too much. We're not seeing the ability to get in front of it. And I think that's the biggest problem, is we're so short in the whole supply chain that, again, companies are price takers. They have no choice but to pay whatever the going rate is on the whatever is coming out of China, Japan, South Korea, whatever the shipping rate is, and then whatever the rail or freight rates are, because they need the product. They don't have the inventory where they can say, look, you're charging me too much. I'll live off of inventory for an extra day or an extra week or two, maybe a month. They don't have that inventory cushion. So you're going to be beholden to this. which is why there's this continuation of getting stuff off the dock, getting stuff into the system, and you can just see how elevated it remains in terms of local deliveries, in terms on container volumes, where we keep seeing this week-on-week growth that just is going to keep the system fairly elevated. After a very cold, at least in the Northeast, a very cold Memorial Day weekend, rainy as well, we're starting to see some of that acceleration, which is, and this is some nice warmth that will come through. And based on the precipitation versus the warmth, it'll also be good for some crops, depending on the region that we're talking about, because some areas are a bit elevated in terms of where they are on droughts. But again, this heat will be fairly welcomed, I think, for some, especially if you're looking at power burns on the AC side. So now when we look at gasoline, so gasoline had a build of 1.5 million barrels. Again, it's 8 million below the 5-year average, but that elevated level, just given where some of these shifts are, PAD 5 had a build of 190,000. And when we look at imports, so imports were down by 101,000, still remaining elevated versus historics. And when you look at PAD 5 was down 13,000 a day, but still 30,000 above the 5-year. And based on what is coming from Asia, it's not just oil that's coming into PAD 5, but it's also that refined product. And that's going to continue to see that elevation on the import side, because typically we focus so much on PAD 1. But because of the problems in Asia, it's actually going to come and hit into PAD 5 as well. So that's going to kind of be those sneaky builds that we continue to see, because when we look at gasoline builds overall, PAD 1 and PAD 2 have the steepest declines versus the 5-year average. But then PAD 3, PAD 4, and PAD 5 are either above or balanced versus the historics. So PAD 1 is going to continue to pull down, but you also had that hiccup with Colonial, which again pulled more through the system, opened up some of that arbitrage. So as we continue to import into PAD 1, PAD 5 is going to be the one to watch to see do imports outpace the reopening on that level in terms of what we've seen coming into PAD 5. And as we showed last week, and then in this past econ show, and then I did a thread on it. When you look at just Google searches in general, you had a lot of that pent-up demand in terms of just what people are Googling and searching for, really peaking in April 25th. And then we've had kind of a steady, slow move down as people kind of fall back within a certain normal. They've already made their plans, and that's where we start to look at some of the shifts. Now, when we look at storage, the thing that we've been talking about is that storage is going to flatline. We're not going to go up. We're not going to go down. It's just we're going to have imports that are going to be able to outpace demand. We have an increase in refinery run rates targeting gasoline, and that's where we're just going to go flat. And as we flatline, the 5-year average really drops off. So if you go flat, then the comps get harder and harder, and things are going to look a bit worse. And that's where we have to look at what is the pace of demand, and is it being met by or exceeded by imports and refinery runs? Because when you look at just what the drawdowns typically are on the 29-year average, you can see that even though we typically get a fairly steady drop, it's just gone sideways. So then when we look at weekly U.S. gasoline from Gas Buddy, you can see that big drop and now that nice little recovery. But that recovery was a mixture of obviously Memorial Day weekend and also that residual of moving stuff through the system. You had people that filled up abruptly in terms of before 2 weeks ago. 3 weeks ago now. So you had over 16,000 gas stations run out of fuel. Now that resulted in people buying and rushing to buy as much as they could. Then they held back because they wanted, as somebody who lived through Sandy in terms of managing, you're scared to drive. Like, when are you going to have fuel? How long is it going to take? So then you pare back, and now you're starting to see some of that activity. So you had not only just Memorial Day fill-ups, but then you had people that hadn't filled up for 2 weeks, now going to, feeling a bit better. So that was a nice little pop. With that being said, things still remain strong. They're essentially about give or take -1%, +1% week on week. So we're still kind of now flatlining at around this level, which is, we'll see a little bit of softness just given historics on typical seasonal moves where you have that Memorial Day surge, a little bit of that last push before kids are out of school, which typically happens in the middle of June. So you have that spike, a little bit of a decline, and then you get that steady move up, which then peaks on July 4th weekend. So according to the Gas Buddy data, weekly U.S. gasoline demand rose 9.5% versus last week, or 4.7% higher than the 4-week average, setting that new COVID weekly high. Now, the weekly changes, I think, is important because Pad 1 saw 15.5% of that big spike. And again, a lot of that is that nuances with those the Colonials. So that's going to be an important one to watch to see how does that normalize going forward, because we did have a strong driving season. So far, in terms of just seasonality, this is when we kick it off. So we normally have a strong start. It's just, what is that going to continuation look like? And this is going to be one of those overhangs. As we had a small little trend higher, we're getting close to $3.03 in gasoline. In some areas, especially if you're on the West Coast, you're already at $3.72. And then in the Gulf Coast, you're still at that low level of $2.71. So the question is going to be, how quickly do we see that accelerate? Because right now we're seeing a lot of those averages push higher and come closer to what we think is going to be about $3.05. Now, on the diesel side, we're already at $3.25. As we were saying, we think it's going to trend to about $3.27, just based on where some of these spreads are. And it's already starting to kick in, with FedEx increased 3 peak surcharges on express and ground shipments beginning June 21st. Which the carrier announced last week. Affected surcharges include an additional handling surcharge, a residential delivery charge, and a peak surcharge on ground economy. Oversized peak charges remain the same. And FedEx cited high volumes, tight capacity stemming from the pandemic, which, again, these are things that are going to just continue to drive through the system, increasing just inherent costs. That's coming to the inflation metrics and where we think some of the pressure is going to remain throughout the system. So then when we look at blending components, we had that increase, and typically if you look at that average, we normally are trending lower just because you need to have that increased blending. So this is also something that's a residual from Colonial, because you had that EPA waiver, and now, but given the shift in refining utilization rates and that shift in refining capacity in terms of what is the target product, this is the one that, again, that we keep talking about, where instead of seeing draws, it's really just going to go sideways. And given the elevated level, we're just going to see some of that, the comps getting harder and showing some of that stickiness in terms of what's in storage. And then when we look across since 2006, you can see that we had that spike up. And this is an important one. We normally see over the last 15 years that drop. So we have that spike and then we have that drop down. The question is going to be what happens next. And based on pricing, based on some of the jobs numbers that have been a bit backwards, back and forth. And when we look at the PMI data, which we talk about in the EIA show, in the Econ show, and we're going to touch on again in the FSC show, we're seeing a slowdown in employment, even though we're starting to see a pickup elsewhere. And that's going to be how are jobs, how are wages, and then when you just look at where prices are going, we still have another surge up in inflation and cost. And that's where we think there's going to be kind of that residual where it's going to just impact plans in terms of shortening, trying to drive a little bit less to preserve some of those tanks of gas. And this is when we kind of peel back the onion and look at those specifics. So when you look at 2018, you had that nice spike up, for Memorial Day, that drop, and then you had that big recovery. So here's what we were expecting was to come down to that low level that we had on May 6th. Instead, we had that Colonial surge. We had 2 of them. Now we have that one move down. We're expecting one more move lower. It'll just be a bit more muted because you had Memorial Day. That's going to trigger more. But remember what we were saying. Ahead of Memorial Day weekend, you typically have guys priming the pump because there's going to be a pickup. You already had some of those hiccups with Colonial, so you had that overreaction to the upside, which is why we think you're going to have that overreaction to the downside, just because you're going to have a bit more left in storage, not moving through the system. Again, these are going to be some of those key components. As typically as we go through the summer months, we average about 9.5 upwards to about 10 million barrels a day. And this is going to be one to watch as that pricing continues to kind of lever in and cause some of those issues, because we're at prices that we really haven't seen, especially in certain areas, for an extended period of time. And given wages and where cost is going on an inflationary level, is going to continue to weigh down some of that buying. Then when we look at propane, so propane had a huge build of 4 million barrels, still 10.7 below the 5-year average. And it's kind of funny because last week we were saying, look, we're tracking pretty close to 2017. And when you look at the rate of change of 2017, this is almost perfect. So again, we think that 2017 is kind of that good gauge as we continue to drift higher. You're going to have less consumption outdoors, less consumption in residential. So that'll, incentive, you will see those additional builds as we do have more production coming from just frac spreads, increasing activity. So then when we look at just the overall numbers in general, when we talk about, new COVID cases continuing to move in the right direction. When we look at vaccinations continue to slow. That's just because people who want them got them. People who don't want them are still kind of a wait and see. Do I need it for going back to work? Some offices are now saying you're going to have to start in June. Some are July. Apple came out and said September. So again, this is kind of that back and forth. And the reopening continues to progress in terms of just more stuff happening here in New York. You don't need to wear a mask if it's up to the person or the company. So again, you're starting to get some of that normalcy back into life. Then when we look at just what has happened so far, the residential still remains elevated in terms of just, people working from home. That transit workplace is had that cross as we had that acceleration of vaccinations that happened end of February, as you saw it accelerate through March and April. Those are some more people using transit. Parks is the one that's going to remain elevated, again, kind of shifting what people are doing as shopping and those trends stay fairly flat. Grocery store had that nice little spike. Who didn't want to go and make sure that they had enough for barbecues? And that's going to be one of those some of those differences that we continue to see. Now, it's interesting because when we look at Apple mobility data, and we talked about this during the pandemic, people who have Apple products typically are wealthier. So this is a good indication of what are the wealthy doing and how are people moving about more. And it continues to see a nice, strong recovery. So the U.S., as again, flatlined along kind of this normal seasonal move. The biggest recoveries have really come in the European markets, where we've seen a nice bounce back above that baseline. And the reason why I talk about Apple as the wealthy is because this is showing a positive move in Europe. But then when you aggregate the toll data and the underlying miles driven, it's still negative. But again, that's just kind of that bifurcation. But the trend is still up, as we talk about in segment 1, when we showed global movements based on just that peak congestion and what do those congestions look like. And here's where we start, Italy, France, Germany maintaining some steady vaccinations. China has really seen an acceleration, and the Guangdong increase cases has accelerated. And as we talked about, the U.S. continues to slow. And India is struggling to see that ramp up. Now, they've just bought 300 million doses. So hopefully they're hoping to kind of close some of that gap and see some of that acceleration. But the U.S. continues to slow. We've now started to offer up from our storage. So we'll see some additional exports of vaccines or donated vaccines coming from the U.S. into the rest of the world, which again will help accelerate some of these areas and keep this last wave from continuing higher. So then when we look at jet fuel had a small build of about 60,000 barrels. Pad 1 had that steady move, where it's still 800,000 above the 5-year average. We had that kind of last surge up, and now we're going to see that drop. And when you look at what has happened in previous cycles, looking at 2016 through 2019, you can see that we have that drop and then that spike up. Instead, this is the spike up, and now we're going to see a little bit of that slowdown. It won't be a lower low. It'll just kind of be within that 1.2 million or so. And that's where we're going to see some of these movements where we're going to stay over 1 million, but again, kind of walk back and forth as we had that big surge for travel. And now we'll see a little bit of a slowdown as families wait for their kids to finish with school. And then you'll see another increase in movements. So when we look at just flight data in general, so here you can see, again, that flat line. North America had again, that kind of stabilization. Asia Pacific continues to get worse as Europe has a nice little recovery, but the rest of the world saw some of those declines as the average number of departures per day decreased by 110 week on week. The UK and Russia led growth, while China and Australia led declines. So this is where we're kind of fluctuating back and forth, where we're really not back to where we were, but you're starting to see some of this, again, this flatlining where Asia's gotten a bit worse, and now it's going to be a matter of how quickly do we start to see some of this reopening. Now, the problems with Asia is the spread of the Indian variant that is keeping people a little hesitant. So I think the Asia Pacific, and you're going to see some of this kind of flat line here as the US also continues to see we had that seasonal move up, and now we're going to go sideways for the next month or so. Now, when we look at TSA passengers, we had that Memorial Day spike, and now we're coming back within, a fairly tighter range where we're getting higher lows and not so much higher highs, but essentially kind of sitting within this nice range. And you can see that typically we normally get this recovery up until July 4th. So on a seasonal level, we should continue to trend up, and we should start to see this move higher. Based on the tightness in this, I think you're starting to see maybe we're peaking out a bit on the upside, but we're not seeing that drop down. So again, we're going to kind of see a bit more of a steady state versus a trend up. Not to say that that's a bad thing, because the lower end is getting tighter, higher end is maintaining those elevated levels. And that's going to, again, why we're shifting up that expectation for fuel demand by about, let's call it 100,000 barrels a day as you start to see some of this movements. But again, a lot of these individuals can go on, they can increase the load factor on the planes and not so much the amount of planes themselves, which is why departures and passengers, there's a correlation, but to a point. And that's where, airlines are going to want to try to make money, especially after losing it for so long. So that's where we're going to get some of that noise coming through in general. But again, the passengers, we think over the next week to 2 weeks, we're going to see it more of a flat line versus that steady progression higher. And then when we look at OpenTable, as we were saying last week, we expected to see kind of that surge back up to flat. That was really going to be driven based on Europe reopening, US getting back to that activity. Here is something similar. We think that, and this kind of feeds into what we've been saying, that the weekends are going to outperform previous, but weekdays are going to underperform. And I think that's going to be something steady, where I think in general, you're going to either see same as 2019 or 10% better like we saw on the 30th on the global side. And then we're going to see, let's call it 15% below on the weekday side. And that's going to be that one to watch as we continue to go up. And now, here we think that we're going to live on the sideways pattern between 0 and 10% once we kind of average it out over the coming few weeks. And now that we've talked about, what's happening within the US, we can kind of turn around and say, all right, well, what's happening abroad? We're seeing some signs of life. Again, it's a little lumpy in terms of some of those nuances, but it's that steady kind of seasonal move. The question is going to be, what is the rate of change? Are we going to accelerate and close the gap, or are we just going to have kind of that steady move up along those seasonal norms? And so far, it looks as though we're going to have that steady move up along seasonal norms, just at a slightly or depending on the product we're talking about, a bit of a reduced rate as we go through, at least through the remainder of June. And then it'll be interesting to see how does the back half of June look as we head into July 4th. Where are gasoline prices if they continue higher? How much is that going to impede some of the purchases and causing people to adjust a bit? So these are going to be interesting things to watch for as we go through the remainder of the month.